Welcome to this explainer. Today, we are breaking down a truly crucial US CPI report from the Bureau of Labor Statistics. And man, the massive domino effect it triggered across global markets is just fascinating. If you happen to be watching the tickers on July 14, 2026, you know exactly what a wild day it was. We're going to dig right into the data, look at exactly what happened, and more importantly, uncover why the markets reacted the way they did. So let's dive into this by highlighting how our source material perfectly describes today's trading session. They called it, quite literally, a roller coaster ride for financial markets. You know the feeling, right? You strap in, you feel that slow, agonizing climb of anxiety, and then suddenly, boom, the drop, the twists, and this total massive shift in momentum. To really understand the scale of this ride, we have to look at the setup. Before the inflation data even dropped, markets were just in full-blown panic mode. I mean, screens were flashing red everywhere because of those terrifying reports of blockades in the Middle East's Hormuz Strait. Oil prices were surging, and investors were absolutely bracing for the worst. But the very second the CPI report hit the wire, it acted like an immediate, potent antidote. It entirely flipped market sentiment on its head, triggering this spectacular U-turn and a massive relief rally across all fronts. Okay, Section 1, the spectacular U-turn. Let's look at that June CPI data. The headline consumer price index dropped by negative 0.4% month over month. Yeah, negative. That means prices actually shrank from May to June. This completely shattered Wall Street's expectations. I mean, it caught analysts entirely off guard, but in the best way possible. And we really need to put this number into some historical context, because this isn't just your everyday minor dip. This represents the deepest, most significant monthly drop in inflation we've seen since the world locked down over 6 years ago, back in April 2020. That is just how monumental this economic cooling actually is. So, you're probably wondering, what caused this massive deflationary pull? Well, the primary hero behind this drop was the energy sector. Energy prices plummeted a staggering 5.7% in June, driven really heavily by significantly cooling US gasoline prices. If we break down the internal dynamics here, the story is super clear. Energy basically violently dragged the overall headline CPI down to that negative 0.4% mark. Meanwhile, food prices, they barely registered a blip, ticking up to 0.2%. But the really crucial part is the core CPI, which strips out those bouncy, volatile things like food and energy. It remained completely flat at precisely 0.0% for the month. This is huge because it proves the cooling is broad-based, not just some random fluke in the oil markets. All right, Section 2, the US dollar slides. DXY sell-off. So the GXY, the US dollar index, just immediately tanked. It faced aggressive, almost instant sell-offs the very second the CPI report was published. It basically fell off a cliff. Now, the logic here is absolutely fascinating. Normally, right, with war tensions escalating in the Middle East, investors would naturally rush to buy the US dollar as a safe haven. But the sheer weight of this inflation drop was just too much. Investors completely abandoned their expectations of a hawkish Federal Reserve keeping interest rates high. And since high interest rates usually pump up the dollar, the sudden expectation of impending rate cuts instantly neutralized the dollar's typical safe haven appeal. Moving right along, Section 3, gold's double benefit. A perfect storm. While the dollar was sinking, gold caught a colossal wave of bottom fishing demand. It went absolutely vertical, pushing the precious metal into a frenzied, incredibly high trading range between $4,000 and $4,100 an ounce. Just a massive spike. The source notes that gold essentially enjoyed what they call a double benefit, or basically perfect timing and favorable terrain today. First, when that CPI data hit, 2-year and 10-year US Treasury yields plunged. Because gold doesn't pay a yield, lower interest rates make holding physical gold way cheaper and much more attractive. Second, those very real geopolitical fears of the Hormuz Strait supply chain disruption just cemented gold's status as the ultimate safe haven. It was a literal perfect storm for a gold rush. Finally, Section 4, equities break barrier, Wall Street rally. Despite pre-market futures drowning in a sea of red over all those oil fears we talked about, the major indices, like the Nasdaq and the S&P 500, completely erased those morning losses. They carved out this incredibly sharp V-bottom and just rallied hard into the green. Wall Street essentially decided to entirely ignore the risk of surging oil prices. Why? Well, because that negative 0.4% inflation print promised something way more valuable to the stock market: upcoming monetary relief. Rate-sensitive tech stocks totally led this charge. For companies that rely on borrowing to fuel their growth, the promise of lower interest rates is pure rocket fuel. So, let's bring it all together and summarize the key takeaways from our source material. Core CPI dropping to an annual rate of 2.6% proves, undeniably, that the Federal Reserve's harsh monetary tightening policies actually worked. By breaking down the barrier of persistent inflation, the single biggest threat to long-term stock market growth has essentially been neutralized. Now, all eyes are going to turn to the next crucial piece of the puzzle, the July CPI report, which is scheduled for release on August 12, 2026. I want to leave you with this thought to ponder as we await the next moves from the Fed and that upcoming August 12th report. With inflation taking a massive, undeniable step back today, is the stock market's ultimate barrier, the era of restrictive high interest rates, finally about to be removed for good? Thanks so much for joining me on this explainer, and definitely keep your eyes on the data.